The crypto market feels like it's been punched in the face for 2 straight weeks, and investors are starting to wobble just like the price of Bitcoin itself. Over the last 24 hours alone, Bitcoin slipped another 1.7%, briefly breaking below the critical $94,000 level and touching an intraday low of $92,950. That may not sound catastrophic by Bitcoin standards, but sentiment right now is extremely fragile, and the market is reacting to every tiny move like it's life or death. Since November 9th, Bitcoin has shed more than 9%, dragging its market cap down from over $2.07 trillion to just $1.88 trillion. That's nearly $190 billion wiped out in a single week. Trading activity is overwhelmingly sell-side, and with more than 135,000 traders liquidated in the last day, totaling almost $400 million, the market feels thinner, more brittle, and more fearful than it has at any point since earlier this year's zoom out, and it gets even more brutal. According to the Kobayashi letter, crypto has erased $1.1 trillion in market cap over the last 41 days, roughly $27 billion per day. There's no major regulatory crackdown, no huge negative headline, no catastrophic hack, nothing fundamentally wrong with Bitcoin or crypto, and yet prices continue sliding. Instead, this entire downturn looks mechanical. Institutional outflows, cascading leverage, hypersensitive markets, and violent swings in thin liquidity conditions. Fear and greed is sitting at extreme fear, 10, matching the February lows, despite prices being nowhere near those lows. Crypto investors know this feeling. The prices drop, the charts look ugly, social media goes dark, and suddenly every bullish prediction from the last 6 months feels like a lie. Right now, that's the mood. Dark, depressed, high anxiety. Everyone is waiting for the next shoe to drop. If you scroll through crypto Twitter right now, the emotional whiplash is obvious. Some say the bull run is dead. Others say institutions have rugged the market. Many retail traders are frustrated, exhausted, and openly asking whether they completely misunderstood the cycle. Yet in the middle of the chaos, there are still a few voices standing tall. Voices that refuse to be shaken by the volatility. 2 of the loudest and most influential, Michael Saylor and Raoul. Saylor is preaching long-term conviction and calling this moment a bottoming phase. Raoul is explaining the macro plumbing behind the chaos and reminding investors what's actually driving this cycle. Today's video features both. A deep breakdown of Raoul's latest tweets, including his warnings, his forecasts, and his framework, followed by fresh insights from Saylor's new interview with Grant Cardone. Before we begin, please take a moment to like the video, subscribe, and leave a comment. Tell me what camp you're in right now. Cycle is over, or cycle is just getting started. Alright, let's get into Raoul's tweets. Surveying the crypto Twitter battlefield on a quiet Saturday to observe the narratives. One camp is saying, the 4-year cycle is over. The OGs are selling. Another camp is saying, more cowbell. Everyone stuck in sub $1 billion market cap, no use case shitcoins are saying, where is my banana? I'm down 85%. Here's how I see it. The debt refi cycle is the cycle, and liquidity is the only way to manage it, the everything code. Don't this up. Raoul kicks things off by calling out the chaos in narratives. Some people think the 4-year cycle has officially broken. Others are screaming for more liquidity. Small-cap altcoin traders are panicking. Underneath the noise, Raoul reminds everyone that the real driver of crypto is the global debt refinancing cycle, and the liquidity needed to keep that machine running. His message is simple. Ignore the noise. Follow the liquidity. In follow-up tweets made on Sunday, Raoul doubled down on that liquidity warning. I think this week the Fed's hand will be forced to tweak the plumbing to avoid a month-end and year-end funding crisis. Crypto is currently trading like a stressed funding vehicle reflecting the broken plumbing, while stocks are cushioned by buybacks and performance chasing for now, but risk a repeat of 2018/19 if not solved immediately. It's clear the Fed are concerned, hence the meeting with the banks and NY Fed to understand why the SRF isn't being tapped enough to resolve this. The fear from markets and the Fed is rising. This week will be volatile until this is solved. The big fix is ESLR changes, which are now becoming more urgent as the key source of financing the deficits and driving liquidity in the future. Not sure when they ramp up communications on that, but an interim fix via repo/SRF is very close to being unleashed. You can hear the cowbell in the distance getting rapidly louder and closer. That will usher in the 2026 cycle extension as $7 trillion of interest payments need to get serviced. Raoul explains that the Fed and Treasury are now in a direct tug-of-war over who controls liquidity. Crypto isn't crashing because of fundamentals. It's reacting to a temporary funding stress, the same kind of stress that hit markets in 2019. If the Fed tweaks the system via repo markets, the SRF or ESLR adjustments, liquidity floods back in. And according to Raoul, that moment is getting closer than people realize. His cowbell metaphor is simple. More liquidity equals cycle extension, which means the 2026 supercycle stays in play. But Raoul didn't stop at macro. He also had a very blunt message for panicking investors. I know many of you are scared, worried you up and think you'll never make it. You need to follow the don't this up rules. You need to extend your time horizon and levels of patience. You are clearly not doing that. Every correction is an existential drama to you that is a sign you are up. Remember, when Bitcoin goes down 30%, quality alts go down 60% plus. It's normal. Bitcoin normally has 5 plus 35% corrections. Others in the last two bull markets saw a couple corrections of 80% and still hit new highs in the index. You may think the cycle is over. Well, if it is, just keep DCAing into weakness, and your future self will thank you. It takes time to play out, and one cycle is not the game. It's not too late to your future. Please don't up. I'm looking directly at you. This is the greatest performing asset class of all time, over time. Pals don't up rules include a set of rules designed to help crypto investors survive volatility and actually build wealth over time. No leverage. Don't borrow money or use margin to trade crypto. Leverage amplifies gains, but it destroys accounts during sudden pullbacks. No FOMO. Avoid chasing pumps or buying just because everyone else is excited. Emotional decisions lead to bad entries. Hold only 3 to 5 main assets. Keep your core portfolio simple and focused. Concentration on your strongest convictions beats owning 25 random coins. Use self-custody with good wallet hygiene. Protect your assets by holding them in your own wallet, hardware wallet, or multi-sig. Avoid sloppy security practices. Keep a small degen bag under 10%. If you want to gamble on high-risk plays, fine, but limit it. Your long-term stack should never depend on moonshots. Hodl with a long-time horizon. The biggest gains come from staying invested through cycles, not trading every dip and pump. Zoom out and ignore the noise. Short-term headlines, Twitter drama, and daily price swings don't matter. Stay focused on macro trends. Expect 35% pullbacks regularly. Crypto bull markets always include major corrections. Don't panic, they're part of the process. Buy the dip if you can. When volatility knocks the market down, that's often where the best opportunities show up. And that brings us to another voice of conviction. A man who has literally bet his entire corporate balance sheet on Bitcoin. Michael Saylor recently spoke with Grant Cardone, and his message cuts through the noise. He believes Bitcoin has already bottomed. According to Saylor, most of the forced liquidation pressure, months of cascading leverage, outflows, and panic, has already washed out of the system. What we're seeing now isn't structural weakness, it's the tail end of deleveraging. He told Cardone that Bitcoin is firming around current levels and should rally from here, emphasizing that only traders thinking short-term are panicking. To entrepreneurs and long-term investors, he says the time horizon is 4 to 10 years, not 4 to 10 weeks. And given Bitcoin's supply cap and global liquidity profile, he sees no scenario, none, where MicroStrategy is forced to sell unless Bitcoin crashes more than 90%, something he called completely unrealistic. Saylor's entire message is about structural strength. Bitcoin is a superior long-term monetary asset. Macro narratives may shake confidence, but fundamentals haven't changed. If anything, this period is simply instructive, a reminder that Bitcoin ownership demands patience, conviction, and strategic thinking. When you put all the pieces together, the macro signals from the BTC letter, the discipline framework from Raoul, and the unstoppable optimism from Saylor, an extremely clear picture of what's coming next begins to form. The BTC letter has been warning for months that macro stress is building under the surface. Liquidity is tightening, rate expectations keep whipsawing, and global markets are behaving like they're stuck between fear and the next wave of expansion. Their conclusion is simple but powerful. We are entering a phase where volatility becomes opportunity. Every pullback, every correction, every moment of panic is setting the stage for the next major risk-on rotation. And historically, crypto has been the first asset class to reflect that shift. On the other side of the spectrum, you have Raoul, arguably one of the few macro thinkers who truly understands the exponential nature of digital assets. His recent "don't up" rules aren't just a checklist, they're a survival guide for asymmetric returns. He's telling us that the biggest mistake investors make isn't missing the top or misreading the timing. It's losing discipline right before the real move begins. When you combine Kobayashi's warning about incoming volatility with Raoul's emphasis on patience, self-custody, and long-term positioning, the message becomes crystal clear. The market is about to get loud, and only those who stay focused will reap the rewards. Then you factor in Saylor, the man who treats Bitcoin corrections like retail discounts. Saylor's conviction acts as a counterweight to every moment of panic. While analysts debate the timing of the next move, Saylor continues to emphasize the bigger transformation happening beneath the surface: institutional adoption, monetary debasement, and the unstoppable migration from weak assets into strong assets. His optimism isn't rooted in hype, it's rooted in math, liquidity flows, and a decade-long structural trend. Together, these three perspectives form a complete map of the current crypto cycle. Macro turbulence is not a threat, it's the setup. Discipline is what keeps you in position long enough to benefit from it. Conviction is what turns volatility into generational wealth. This is how you don't fun it up. You understand the macro picture, you position correctly, you hold through the noise, and you let exponential assets do exactly what they're designed to do. If you found this breakdown helpful, make sure to hit like, drop a comment telling us your strategy for this cycle, and subscribe so you don't miss our next deep dive into the biggest crypto and macro trends shaping the markets right now. Your support helps the channel grow and allows us to bring you even clearer insights every week. Thanks for watching, and I'll see you in the next video.